We often think of bonds as the quiet, predictable corner of the financial world, a safe harbor, perhaps, offering a steady stream of income and a reliable hedge against the stormier seas of the stock market. It's an image of simplicity, a straightforward contract. You lend money, they pay you back with interest. But what if this perceived simplicity is, in fact, a carefully constructed veil? What if beneath the surface of stated yields and maturity dates lies a complex language of signals, a hidden dialogue that, when decoded, can unlock critical insights into the very health of our economy and the direction of future market movements? Benjamin Graham, the father of value investing, taught us to look beyond the obvious, to unearth the invisible assets and understand the intrinsic value of a business. He urged us to peer into the soul of a company. Similarly, in the vast, often misunderstood realm of fixed income, the true value, the profound intelligence, lies not merely in the numbers printed on the bond, the coupon rate, the maturity date, the stated yield. It lies in the subtle, often overlooked signals that whisper about underlying economic currents, about shifting investor sentiment, and about the potential risks that conventional wisdom might ignore. This exploration is not about the frantic chase for higher yields, a pursuit that often leads investors down paths fraught with unforeseen dangers. Instead, it is about cultivating a more profound, a more critical, a more data-driven lens. It's about learning to interpret the bond market's subtle whispers, to transform them into actionable intelligence, the kind that empowers the truly discerning investor. We are going to move beyond the superficial, beyond the headlines and the easy answers, to understand how the bond market, in its intricate dance of supply and demand, of interest rate expectations and inflation forecasts, acts as a sophisticated barometer. It reflects not just the immediate financial landscape, but the deeper, more fundamental forces at play, from the subtle shifts in inflation expectations and the intricate choreography of central bank policy, to the creeping shadows of systemic risk and the ever-present currents of investor psychology. What are these signals truly telling us? The yield curve. We often see it as a mere line, a simple depiction of interest rates across different maturities. A normal curve, sloping upward, suggests longer-term bonds offer higher yields for the added risk. But this seemingly straightforward chart is far more. It's a financial crystal ball, a powerful economic indicator that many investors consistently misread. Understanding its shapes, normal, inverted, and flat, reveals what each portends for economic growth and recession probabilities, a fact borne out by econometric data and historical recessions. Consider the yield curve, a weather forecast for the economy. A normal curve signals partly cloudy with a chance of growth. An inverted curve, however, is storm clouds gathering with a high probability of severe economic weather. This analogy holds because the inversion reflects the market's anticipation of future economic contraction and impending policy shifts. The myth persists that an inverted curve asterisk causes asterisk recessions. The data shows it more accurately. Asterisk reflects asterisk market expectations of future economic weakness and anticipated central bank responses, like rate cuts. It's a consensus forecast, a collective bet on the future. Psychological biases, such as herd behavior, can amplify these signals. The actionable insight is to analyze the spread between short-term and long-term Treasury yields, like the 10-year versus the 2-year or 3-month. This spread acts as a leading indicator. Watch for changes in these rate differentials and the market sentiment driving them. The hidden truth is that mastering the yield curve's interpretation grants access to one of the market's most sophisticated predictive models, a model often overlooked by those solely chasing immediate returns: credit spreads. At their core, they represent the difference in yield between a seemingly risk-free bond, like a US Treasury, and a corporate bond of a similar maturity. This gap, this spread, is essentially the danger fee investors demand for taking on the added risk of lending to a corporation, a fee that widens or narrows based on the perceived likelihood of default. When this fee spikes, it's the market's way of sounding an alarm. It's akin to a siren blaring for corporate solvency, signaling that the perceived risk of default is increasing. However, it's a myth to believe that widening spreads are always and solely about fundamental company weakness. While a company's financial health is a significant factor, broader market dynamics can cause spreads to blow out even for fundamentally sound entities. Liquidity crunches, a fear of contagion spreading through the financial system, or the manifestation of systemic risk can all contribute to this phenomenon. These periods, when fear overrides fundamental analysis, can create significant opportunities for the critical, discerning investor who understands the true drivers. For practical application, analyzing the spread behavior across different credit ratings is key. Observing how investment-grade bonds and high-yield or junk bonds react can provide a vital pulse check on overall economic sentiment. Are spreads widening across the board, suggesting a general economic malaise, or is it isolated to specific sectors? Tools like the ICE-BOFA US High Yield Index can offer valuable insights into these broader trends. The hidden truth here idea is that credit spreads offer a real-time, granular indicator of the market's collective judgment on the solvency and stability of the entire corporate sector. They provide a vital pulse check on economic health that goes far beyond simple interest rate movements, revealing the underlying robustness or fragility of businesses across the economy. Treasury inflation-protected securities, or TIPS, play a crucial role in hedging against the erosive power of inflation. Their unique structure means their principal value adjusts in tandem with changes in the consumer price index, offering a measure of protection. But beyond this direct hedge, the yield on a TIPS, when contrasted with the yield of a nominal Treasury bond of the same maturity, unlocks a deeper insight: the market's implicit forecast for future inflation. This difference, often termed the break-even inflation rate, is a powerful signal. Many investors perceive inflation merely as a cost, a simple erosion of purchasing power. However, the hidden truth is that inflation expectations, as signaled by the TIPS market, are a potent driver of bond yields themselves. These expectations can foretell significant shifts in economic policy, profound changes in consumer behavior, and evolving corporate pricing power. They are a narrative whispered by the market about the future. To gain a critical edge, we must learn to calculate and interpret this break-even inflation rate. By comparing the yield of a 10-year Treasury to that of a 10-year TIPS, for instance, we can gauge the market's sentiment regarding future inflation. What happens when these expectations, as embedded in the TIPS market, diverge significantly from current CPI readings? This divergence can reveal market anxieties or complacency that warrant closer examination. By understanding TIPS and the break-even inflation rate, you gain direct insight into the market's forward-looking inflation narrative. This is not just an academic exercise. It is a crucial piece of the puzzle for effective asset allocation and robust risk management, especially in an economic landscape that is constantly evolving. It allows you to look beyond the present and into the market's collective vision of what is to come. Central bank communications are not mere pronouncements. They are potent forces that directly shape bond yields, often long before any actual rate changes materialize. Speeches, meeting minutes, policy statements, these are the instruments through which central bankers signal their intentions. The bond market, in its relentless pursuit of efficiency, acts as a primary decoder, rapidly pricing in the implied future actions and their profound impact on liquidity and interest rates. This is the art of reading between the lines. Think of central bank policy statements as cryptic messages from the economic guardians. The bond market, acting as the collective decoder, doesn't wait for explicit instructions. It immediately begins to price in the implied future actions. An announcement might suggest a pause in rate hikes, a subtle shift towards easing, or a commitment to quantitative tightening. Each nuance is scrutinized, and the resulting adjustments in bond yields reflect this sophisticated interpretation of the economic guardian's words. This process, however, is fraught with hidden risks. The danger of misinterpreting these signals or reacting too late can be substantial. Psychological biases play a significant role here. Recency bias, for instance, can lead investors to overemphasize the most recent statements, potentially ignoring the longer-term policy trajectories that central banks are carefully charting. Understanding these biases is as crucial as understanding the policy itself. For a practical strategy, we must meticulously track the market's reaction to pronouncements from bodies like the FOMC. How do bond futures and options prices shift in response to these statements? These instruments can offer invaluable clues about anticipated policy moves and their potential magnitude. By observing these reactions, we gain a forward-looking perspective on the market's interpretation of central bank intentions. The critical truth is that the bond market is often the first and most sensitive responder to central bank policy shifts. By understanding how yields react to these signals, investors can anticipate economic changes and adjust their strategies proactively, rather than being caught reacting to events long after they have been priced in. This is where true strategic advantage lies. In the intricate world of finance, a liquidity trap can emerge, particularly within the bond market. This occurs when monetary policy struggles to stimulate the economy because interest rates have already sunk to near zero levels, and individuals and institutions prefer to hold onto cash rather than invest. In such scenarios, the demand for bonds, especially safe haven ones, can skyrocket, paradoxically pushing yields lower even as the economy stagnates. Understanding this dynamic is crucial for interpreting bond behavior. Then there is the phenomenon known as a flight to quality. Imagine a burning building that represents risky assets like stocks or lower-rated corporate bonds. A flight to quality is the collective, rapid evacuation from that burning building towards the safest shelter imaginable. High-quality government bonds, such as US Treasuries. This surge in demand for safety dramatically compresses the yields on these secure assets, making them even less attractive from a return perspective, yet signaling their essential role as a refuge. When these two signals converge, converge, extreme widening of credit spreads on corporate bonds alongside a sharp, almost desperate drop in safe haven Treasury yields, it reveals something profound: systemic fear. This isn't just about individual companies facing trouble. It's a broadcast of deep-seated anxiety and the potential for a cascading crisis across the entire financial system. This is the kind of signal that can be missed entirely if one is solely focused on the analysis of individual securities. To gain actionable intelligence, we must monitor the simultaneous movements of several key indicators. Look at the widening spreads in corporate bonds, the narrowing yields in treasuries, and crucially, the behavior of the volatility index, the -1. These combined signals can act as an early warning system, alerting us to nascent market instability long before it becomes obvious. The profound insight here is that in times of extreme stress, bond market signals transcend mere risk premiums. They begin to broadcast the collective survival instinct of the market itself. They offer a stark, unvarnished view of systemic fragility and underscore the urgent need for caution and a critical re-evaluation of risk exposure. We've journeyed through the often overlooked landscape of the bond market, moving beyond the superficial to uncover the critical truths embedded within its signals. We've seen how the yield curve, far from being a simple line, acts as a powerful predictor of economic health, a veritable crystal ball reflecting market expectations. We've dissected credit spreads, understanding them not just as a measure of risk, but as a vital barometer of corporate solvency and broader economic sentiment. We've delved into the secrets of the TIPS market, decoding the inflation narrative that shapes future economic policy and consumer behavior. We've learned to read between the lines of central bank communications, recognizing how their subtle signals reverberate through bond yields. And we've understood how extreme market conditions can broadcast systemic fear through a flight-to-quality phenomena. Warren Buffett, a titan of investing, offered a simple yet profound piece of advice. Rule no. 1. Never lose money. Rule no. 2. Never forget Rule no. 1. While it's impossible to eliminate all risk in investing, understanding these hidden truths within the bond market is essential for making informed decisions. It's about mitigating avoidable risks, preserving capital, and truly understanding the economic landscape that underpins every investment. This knowledge transforms uncertainty into a more navigable terrain. The critical investor, the one who thrives amidst complexity, doesn't just see numbers on a screen. They interpret a sophisticated language, a dialogue between economic forces and market participants. By applying rigorous, data-driven analysis and a healthy dose of skepticism to these bond market signals, you can begin to transform uncertainty into tangible opportunity. This is how you build a more resilient, more sustainable strategy for wealth accumulation. Continue to hone this critical lens. The bond market, often perceived as the quiet, perhaps even passive, partner in an investment portfolio, is in reality one of the most vocal and revealing indicators of economic health and future market direction. Master its language, learn to decipher its whispers and its shouts, and you will master a crucial aspect of financial foresight, empowering you to navigate the complexities of the market with confidence and clarity.